In this session is first, I'm going to set the scene a little bit with a kind of higher level framing of this topic, and then a bit of what I'm seeing with some of the emerging pricing models and options we have in open finance. And then we will hear from our three presenters on how this is being approached in their market. And you will see it is a constantly moving policy environment. It's a very interesting time for pricing policy in open finance. And then we'll have some questions for them that I've got. And I encourage you, please use the question and answer function in the chat to put your questions, as they come up, and we will absolutely circle back to them at the end. Thank you very much. So I think what we want to remember with open finance, while it is about public good and liberating consumers' data from data silos, open finance is about infrastructure, and that infrastructure has a cost. And so whether there's commercial models or whether it's being paid for by large providers or governments, someone is paying for open finance. And looking at models across the globe, there's kind of four main costs that I think we need to think about when we're developing open finance regulations and as we're maintaining and growing the system. So the first is the upfront costs to build the system. And a nice thing that we're seeing is that this is getting less expensive as we see the new generations of open finance, as we have more software as a service solutions in this space, more kind of off-the-shelf packages. But commonly, the upfront costs have been borne by larger financial institutions like large banks in most markets, although that is starting to shift to have more equitable distribution of initial costs. The second cost is once you have open finance up and running, there's a cost to each API call, to each transaction performed. And these costs vary by the complexity of the system, the complexity of the transaction, basic data transfer versus, variable recurring payments infrastructure, for example. And I think that's important to understand that you're going to have a diverse range of activities in open finance, and figuring out a costing model for those activities can be quite complicated. And one of the biggest debates, and I want you to remember this, is whether to have it be cost recovery or value-based pricing. Are you charging for transactions to recover the costs to perform the transaction, or to reflect some sort of economic value of the data or the activity? There's a very big difference in pricing policy depending on that. The third thing is the maintenance and operations. And one thing we've learned from the first markets is that if you update the standards a lot, you increase the costs. And updating standards is important, and it happens a lot in the first few years. But it is important to remember that each time you update API standards, you are creating system costs and back-end costs for participants. And then finally, as we expand the system, what new use cases will emerge? What is their cost? What are the commercial opportunities they raise? Does that change your pricing policies? And also, do new use cases in new sectors mean more participants can contribute to the shared infrastructure costs? The early evidence you can see from the box on the right of costs is it ranges widely. In Australia, participants reported a wide range of costs depending on if they were a large bank with legacy banking systems that had needed significant updates, or a relatively agile small fintech. And that's where I think it can be hard to account for internal costs of individual participants. So what's being done out there? In my review of global models, I see 5 main pricing models. The first one is the free market approach, where you are just leaving it open to commercial rates. And that's the simplest approach to implement, but then you have to worry about some risks of anti-competitive pricing. Does this raise costs for consumers because you have higher margins being charged because of concentration of data or market dominance? The complete sort of opposite of this is no charges allowed in this data sharing ecosystem. And many of the early markets started with this, but as you'll see in our discussion, they're shifting to consider commercial models for sustainability in the long run. The third is some countries like Brazil have threshold pricing in their regulations, where you get a certain number of API calls or transactions for free, and then beyond that, you may be charged. If you are the one requesting the data, you may be charged by the API provider. The fourth, we're seeing countries like Australia where open finance did not have charges, now allowing for the introduction of premium services. So maybe it's data that is not covered in the regulation, or it's advanced analytics services. So adding these premium APIs where you can have charging and layering them on top of the free data sharing APIs. And the fifth, and this is becoming more and more common, are models where you kind of have utility pricing. So you have some sort of central entity that is setting a price based on cost recovery, what they think it costs to maintain the open finance infrastructure, and then participants pay per transaction or API call as part of a pool of funds to support that. And the rates are recalibrated over time. And Korea is a good example, the United Arab Emirates as well. So let's look at a few of these models. So India is an example where you do not have pricing rules in the regulation, nor yet from the standard setting body Sammati that is leading much of the implementation. And in India, you have these account aggregators that manage the consents for the data requests between financial information providers and financial information users. And the compensation model there is account aggregators will integrate with a financial information provider, and then they will charge financial information users, like a fintech that wants banking data on a customer. They will charge to manage the consent to authorize the data transfer. And I think this has helped the model grow quite quickly, as Monami will share. But for me, it also raises some concerns about equal access to data and the potential to use pricing to discriminate or to maintain competitive advantage. We have in Brazil and Chile, as I mentioned, this threshold pricing, which is an interesting model where you set certain amounts of free calls, and you can see it's different for KYC or identity information versus transaction data per month. What can be nice about that is it can discourage excessive API calls, which is something banks and other large institutions will complain about, that they are constantly getting API pings from some entities like financial management dashboards. Challenges we're seeing is that it can be hard to implement this variable billing system without a centralized infrastructure. And Janine will talk more about this in detail. Then I wanted to share one of the cost recovery models. I mentioned Korea before. And Korea has a central entity, the KFTC, that implements their open banking. And what it does is it is the channel by which it facilitates the API calls. And it works with its members to every few years recalculate the shared infrastructure costs for KFTC to run open banking. And then it sets a new pricing schedule. And as you can see, they price different types of data calls differently, right? So different ones for certain types of accounts versus credit cards. And I think it's also worth noting that Korea has different fee windows for large and small institutions. And this is an important point when we think about innovation in open finance, because there's a concern that's been raised in some of my consultations that if you introduce commercial terms in open finance, you will kill innovation because new fintechs will not be able to pay for all those API calls. And so I think Korea introduces an example of where you have reduced or discounted pricing. You could also consider, a certain free API call window of a certain number of months or volume to encourage young fintechs. And then as they mature and prove their model, they start to contribute to the costs of the system. So just to conclude my kind of overview, and this all will be coming out in a report that I'll be releasing soon on pricing models. These are sort of 5 of my personal lessons on pricing in open finance. I more and more am leaning towards the regulator should set prices, because I think we're seeing, like in the US right now, how entities like JP Morgan are using commercial pricing power to try and steer open finance and possibly do anti-competitive practices. And so I think this is important. You may need a utility-based approach to pricing. I think it might be too hard to try and factor in the internal operational costs of participants. I think maybe open finance pricing should focus on the shared infrastructure costs, because it's going to vary so much depending on your legacy systems and the size of your operations. I think you absolutely should not let firms charge different rates for the same services, for the same API calls, so not having discriminatory pricing. Fourth, I think that we need to think about, if we allow commercialization or we allow pricing, how does that impact affordability and financial inclusion? There are some jurisdictions like Chile where they do not allow you to charge costs to the consumer for the infrastructure development and maintenance of your open banking infrastructure. And so those are kinds of law or rules to reduce the likelihood of pass-through costs to the consumers. And finally, it's important to think about, do my open finance pricing rules conflict with any data portability rules in the general data protection rules of my country, which might mandate free data portability? So those are some of my initial thoughts, but more than hearing from me, I think it's important to hear from markets that are in the middle of implementing or considering adjusting pricing approaches. And so I'm really thrilled to have global diversity, but also model diversity in this panel. And so we're going to hear from Janina Suarez, who is a financial sector specialist and one of the core team members on open finance with the Central Bank of Brazil, one of the global leaders in open finance. We'll hear from Monami Dasgupta, who's the head of research and public policy at D91 Labs, which produces fascinating research, and I highly recommend joining their listserv, and also with Setu, which is a service provider in the account aggregator system in India. And then Richard Koch, who is the head of payment policy for Open Banking Limited, and right now is heavily involved in this interesting discussion in the United Kingdom to introduce commercial terms on variable recurring pricing in open banking. So moving from a purely non-charging model to introducing some commercialization. So I'll now turn it over to Janina to take us through the approach in Brazil so far, and then we'll hear from the other panelists. Janina, the floor is yours.
Thank you, Rafe, and thank you for the ideas also. I think you are somehow aligned in those ideas for the pricing model. So good morning, everyone. It's a pleasure to be here at the Financial Inclusion Week 2025 and to participate with this conversation with Rafe, Monami, and Richard. And I would like to thank Rafe for this invite. So I'm at the team responsible for regulating and coordinating the implementation of open finance since 2020. So since the publication of the joint resolution number 1 that set the main first principles and rules for the implementation of the system in Brazil. So I can say I'm here since it was officially born. So the topic here is not to go into details of our open finance, but I'm available to talk to whomever is interested. So if you want to know more about it, I feel free to write me at any time later. So to be answering the question of who should pay for open finance, we need to understand its purpose. So Rafe, you can go to the next one, please. Thank you. In Brazil, open finance was designed to promote competition, encourage innovation, increase the efficiency of the Brazilian financial and payment system, and ultimately also to promote financial inclusion. And in the end, advance, oh, no, you can go back, please. And in the end, advance in the quality financial inclusion. So to make this vision a reality, in 2020, the participant institutions, they came together to create an initial governance structure. Next one, please. The structure later evolved into an open finance association, as it's known today, which now coordinates and sustains the ecosystem. So just to make sure that everybody's aligned here, the structure is not run by the Central Bank of Brazil. It's run and funded by the participant institutions. So the association now, it's the new name now, Association Open Finance Association. It was formally created in December last year. It aggregates over 700 institutions, and now we call it the new governance structure. Why? So last year we updated the rules for the structure, and we focused on voting power, funding, among other factors like professionalism and sustainability of our open finance. So the new rules created a better balance between voting power and financial contribution. But it's important to emphasize that no single institution or representative entity, that's those entities are the ones that represent the institutions at the governance structure, holds absolute power. We made sure that these were in place. As you can see, the scale of the system is impressive. We are now have over 111 million active consents and 3.5 billion weekly API calls regarding data sharing and payment initiation. This number shows the magnitude of the ecosystem and the importance of ensuring it remains efficient and inclusive, which leads us to the next slide, that is the cost recovery or reimbursement for sharing the data. As Rafe showed in his presentation, in Brazil, reimbursement between institutions is prohibited for payment initiation services. For data sharing, although regulation allows for cost recovery between participant institutions, it has not yet been regulated. So it doesn't exist so far. So why? Well, first of all, building a billing infrastructure would be extremely costly and complex. And this was concluded by all the institutions and the regulator also in a debate at the governance structure. So institutions concluded that the effort to calculate and manage net balance wasn't worth at the moment, especially since the largest data transmitters are also the largest data receivers. So in practice, the net balance was often neutral. Also, it's worth mentioning that we put in place and in regulation some traffic limits that Raf said that Rafe said that to avoid abuse of the API callings all the time. So it helps maintain its efficiency and reducing costs for the data holders. Next slide, please. So pricing consideration. So who would pay for open finance? So before we even discuss pricing models, we need to take a step back and consider some key factors here. And I talk here from the perspective of our open finance and our reality. So I have to make this disclaimer. It's not this one size fits all for everybody. So that's how it worked in our open finance. First of all, reciprocity is crucial. It's essential. So it's not a substitute for a billing model, but it helps incentivizing the incumbents. Also, it's important that we must avoid models that disproportionately burden fintechs and small institutions, given the goals we set for our project, such as promoting competition, especially in a concentrated financial system like Brazil. And also at this stage, you can go on, Rafe, please. Yes, and can continue.
Okay, sorry. Oh,
Thank you. No, no problem. And also at this stage, our main priority is to improve performance in monitoring. But once the ecosystem is stable, we may revisit pricing discussions. It's not that we are against pricing discussion. It's just that now our main priority is to make the system stable. So what I think is that any future pricing model must be fair, transparent, and aligned with our regulatory principles and our goals to open finance. So just to finish up here, this first part, for us, open finance is a collective effort, and its sustainability depends on the shared responsibility between institutions and also regulation. The question of who pays is not just financial, but it's strategic. So, and in Brazil, we are committed to ensure that the cost of inclusion is not exclusion. And I'll stop here, and I'll give more details during our conversation. Thank you very much.
Thank you so much, Diana. That was an excellent overview of the present and also the plans for the future in Brazil. We'll now turn to Manami. Manami, I will hand it over to you to talk a bit about how this is being approached in India.
Sure. Thank you so much, Rafe, for inviting me to this panel. And I'm really looking forward to all the insights from all the other panelists, Dana and Richard. In India, in fact, when we talk about open finance, we're also kind of talking about the digital public infrastructure that is built in India. Right now, India is proving to be an example for the world in terms of the amount of API-led and TPI-led, technology we've built in-house, especially when we talk about real-time payments, which is UPI. We have a host of digital public infrastructure, and I'll take a minute to kind of talk about what those are. We have real-time payments, which is UPI. We have your digital identity stack, which is all the identity solutions related to Aadhaar, which is eKYC, DigiLocker, eSign, and new things coming up in terms of biometric face auth, etc. We have Bharat Bill Payment System, which is again for bill presentment, and then we also have DPIs, which are for underwriting any loan, such as account aggregator, which is the Sahmati that Rafe referred to, as well as the unified lending interface by RBIH. And if I kind of go deeper into just the underwriting DPIs, which is the two digital public infrastructure, and I use these terms kind of interchangeably in terms of open finance and DPIs. In India, the thought behind creating any DPI is to basically create a foundational layer over which the private institutions can innovate in whichever way they feel fits best for the business, and then accordingly even charge and price for it. We for different DPIs that I have kind of put on the on the slide over the years, the models have been very different. In fact, for UPI, the government used to heavily subsidize. The subsidies have gone down now, but it is really free for users and merchant to a great extent. There is a fee that NPCI, which is the regulating body, does earn per transaction in terms of interchange fee, and there are a couple of other fees involved. But for each transaction for the user and the merchant, it's basically free, and it's doing really well. We have currently clocked in 20 billion transactions in the last month. So it's really, really doing well. When it comes to other DPIs, which are not about real-time cash payment or payment transfer, for instance, account aggregator and ULI, these are basically models that help consent-based data sharing between financial institutions. And there I agree with Rafe that the pricing is a little all over the place. Currently, what's happening, so Sahmati is the body, the non-profit body that takes care of all the integration that's required from FIU, FIP, all the data sharing, etc. They're basically running on membership fee, a little bit of sponsorship from members, as well as broadly, it's a member-driven format. In terms of cost, one of the problem areas that financial institutions face in terms of, for sharing data is related to infrastructure maintenance, other technology pulls, and just generally kind of upkeep of the APIs kind of running in the background. And somewhere, I think in the industry, people do believe that the cost maybe needs to be compensated by someone. We don't know who that someone is right now, but maybe that cost needs to be compensated. And also the cost differs based on who you are. If it's a fintech in the account aggregator ecosystem, then they have a little bit more sophisticated models and maintaining data system. The cost probably is slightly lower. For banks with legacy system and with a core banking system, it's not that efficient. So costs are more. The time taken is more. So there is no one kind of cost that fits or everybody incurs in terms of providing this service. So what I'm really kind of hinting towards is a lack of incentive for people to do this altruistically in terms of sharing data and receiving data without taking care of who should pay for this, right? And right now what's happening in the industry in India is that in terms of account aggregator, it's becoming a little bit of a cutting cost which goes to race to the bottom, and we are kind of pricing in. Of course, it's discriminatory. It's also kind of very low, so that there is much more customer acquisition. And so there are only two models right now exist, that either you charge really really low, or you charge higher for value added products, etc. But in terms of what really clicks is the low charge, and that kind of starts setting a threshold for the industry at large. So broadly, what I'm trying to say is that the DPIs were built as a public good, but the commercialization of it is really on the private entities that are using it and even kind of creating value-added services on it. Of course, free is not sustainable, but it also would make us think who is going to pay for it. Is it the end users? Is it the member? Who's really in charge of kind of paying for it if there is a significant cost attached to it? In terms of what should we really do, I agree with Rafe on all the points that he has raised, but I think one of the things that we have to realize is we need to recognize the trade-off. So open finance typically operates at the intersection of public good and market economics. So if it's fully free, it's sustainable for scale. Example, zero MDR for UPI. If it is fully commercialized, there is risk of paywall, there is risk of concentration as well as consumer exclusion. So we need to maybe design a regulated price regime that balances affordability as well as sustainability. I also kind of think there should be transparent regulated fee caps. For instance, we can introduce standardized fee bands or even maximum allowed charges, for interchange fee, for MDR. Maybe we can kind of think of that kind of models, and also probably create a fee disclosure framework, especially for account aggregator. And if the regulator pushes for that, all the entities can file a tariff structure ensuring visibility and preventing any exploitative pricing. And as Rafe also mentioned, based on the use case, if it is for inclusion, there could be one kind of price band. If it is for more premium and commercial services, there could be another kind of price band. And that kind of maintains, cost per use case kind of a scenario. I think that's all the points I have as of now, and I can come back to a longer discussion over time.
Thank you. That was fascinating, and it really sets up well hearing from Richard, because one of the points you've raised, Manami, is we're trying to kind of marry public good concepts and DPI with commercial models, and it's a really delicate balance. And so it makes sense that it's complicated and it's evolving over time. And I really appreciate the points you made too about how pricing models may need to have some windows for inclusion and some windows for perhaps a more purely commercial-based model. Richard, I would love to hear from you about how things are going. I know you're right in the middle of developing the first commercial model in open banking in the UK.
Thanks, Rafe. It's a great pleasure to be with you this morning. So, as you say, just by way of reminder, open banking, when it commenced in the UK, was the result of a competition remedy. So it was chosen by our competition authority as a mechanism to introduce more competition into retail banking, where they determined there wasn't competition, and they saw the power of data in current account for alternative providers in the fintech sector to be able to create value that competed not for the core product of a current account, but for ancillary services. And that's indeed what we've seen. We've seen the emergence of different approaches to making, say, foreign transactions, which often are at cost to consumers, and a range of different services that enable people to disaggregate some components of their existing current account and utilize other suppliers for it, which is clearly intended to put pressure on existing incumbents in retail banking to sharpen their pencils and to work harder for their customers. And a lot of that is evident. So that's the origins. And so of course the approach was that data would be supplied for free to the fintech community. The downside of that approach is that, as some of the other speakers sort of alluded to, there's no real incentive if this activity is purely regulated. Banks will do it, of course, and they have. And actually, the UK, in terms of availability and performance, has done reasonably well, actually, and there's very significant volume growth. So there's lots of reasons why that regulatory front ending, I think, has been quite successful. But I think it's recognized that it only takes you so far. And the problem is that with the regulated approach is that lack of incentive means that when we want to do something that extends open banking and introduces new functionality, capabilities, we're always bound by the competition order. So there's legal challenge as to whether we're allowed to go to the next step of this, rather than that commercial conversation about this looks good. Wouldn't we like to do this and adopt this and move forward? And that's that's a large anchor that I think holds us back, and that is recognized. So where we want to go beyond what the scope of the regulation is, such as in this new payment type, variable recurring payments that Rafe mentioned, we've acknowledged that actually that is an area in which those banks who are supporting it need to get some commercial return. The UK is approaching this with a bit of a backstop as well. So I'm in the middle, as Rafe said, of trying to get the setting up a new scheme. It's intended to compete with cards, with Visa and MasterCard. That is a regulatory objective. They want more competition in the market, and for obvious reasons. And we are trying to establish an industry-owned and industry-led company and board that will set the pricing for this and achieve that objective. However, there is legislation in train. The Principal Act's been put into law, and the government can use it if, in the event that the industry alone is not able to find a satisfactory price, or fails to achieve a price, or a price that achieves the ultimate sort of North Star objective that the regulator wants. So the regulator can step in if there's failure, as ever, but they are really encouraging the industry to try and do this for themselves and sort out a commercial model that does provide those incentives. So that's that is the direction of travel. Just to to touch on some of those other things, there is issues in the UK market about overuse of APIs. Apple, for example, in relation to their Apple Wallet, has introduced a fabulous functionality that allows, when making Apple payments and Apple Pay payments in the UK, users to see their balance. That's of course generated through a data API. But under the current arrangements, Apple don't contribute anything to a significant volume of calls. And when you look back at the regulatory intention, it's not clear to me and others that was the original intention, that Apple, a massive company, gets the benefit of an enhanced product that's popular with its customers, and is not in that process. There's no obligation for it to compensate the banks who are having to develop capability to resource quite a significant volume of API calls. So that is also a current consideration with the UK market as to how you balance that fairly. Finally, I would say, just interesting, we've started with payments, and primarily in the UK we've started with payments because I think that is an area in which the fintechs can actually commercialize a product. I think it's much more difficult in the data space, certainly in the UK market. Consumers are unwilling to pay for data-related services in that way, and similarly, they wouldn't pay. Normal consumers wouldn't pay for payments, but the merchants have there's a lucrative market to sell the product to merchants that would generate return for the fintechs. But we are looking at some interesting use cases. So one that's quite well developed at the moment works in entirely a different way. In the UK market, there's some issues with SME lending, and the banks in this case would really love to access data that accounting platforms hold on SMEs. It would really enhance their decision to be able to see live P&L rather than relying on historic account data from our tax authority and so forth. In that case, the flow would be in the other way. There's no obligation on the part of QuickBooks or whoever to supply that data to the banks for their purpose and at a value without some compensation for it. So I think it's the reciprocity issue that you've heard earlier this afternoon, that actually this can work both ways in the equation. It's not always that the data supplier isn't always the incumbent banks or incumbent financial institutions. I'll stop there, Rafe, because I've spoken.
Thank you so much. And I think it's great. You mentioned reciprocity, just like Janaina, and I'm glad you brought in big tech, because I think that's a principle that will be good to apply through as open finance pricing evolves and open finance merges with open data. I love that example of QuickBooks. And what I'm hearing from all of you also that I think is important for the audience is, it will evolve over time. I don't think any one of your markets has gotten it perfect, and you're three of the leading markets in terms of scaling. And so we don't have to be perfect on the pricing. It is an evolving journey, but it's something we do need to pay attention to ensure incentives to grow new use cases and innovation and the long-term sustainability. Because eventually, if you're just sort of charging a few large players, they're going to get quite upset. I want to turn to questions. We've got some great questions. So from Louisa Lane, we have a question. It says, what can possibly go wrong? So what do policymakers need to be careful about when designing, implementing, or adjusting pricing policy for open finance? So what do you need to be careful about as you're modifying this over time? I'd love to hear reflections from you all. Maybe Janina, do you want to start first as the official policymaker?
Okay. Yes. So it's a very good question. We thought of that. So when implementing the project, because charging fees could slow down innovation in a certain way, especially for fintechs and digital banks. So, like for the Brazilian case, especially over the last decade, when we started the regulation for the payment institutions. So Brazil has welcomed a variety of fintechs and digital banks and the PISPs, as we call it, that were born in this digital era and have truly transformed our financial landscape. So we don't want to create barriers that prevent them to continue to innovate. So that's one thing we have to be careful. Incumbents, on the other hand, often respond to competition by innovating. So they don't want to fall behind. But they also tend to have a legacy system and aren't always the first ones to adopt the technology. So it's important to keep the environment favorable to innovation across the board. So when charging the fees, I think it's one thing we have to be careful, and also with a strongly regulatory oversight, because it's key to ensuring a good performance from all the institutions. And that doesn't necessarily mean that we need to authorize fees to achieve that since the beginning. I think we have to, like J3, she asked in the questions, like we have to see the maturity of the ecosystem, and not only of years in implementation, but is the data quality working for the fintechs and the digital banks in order to deliver good service for the consumers, because we had this problem for some time, so we need to a fixed pause in order to fix this issue. So if the data quality is not good enough, and they're not getting data as they supposed to, how can they offer the service of better service to the customers? So we need to take this maturity into the equation as well.
Excellent. I want to ask Richard and Monami if you would answer the question from Comfort from the Reserve Bank of South Africa, who's asking, looking back, would it have been better to establish commercial models before implementing open finance, open banking? For countries yet to begin, would you advise them prioritize commercial models up front, or start with free access and evolve monetization later? I'm curious about the UK and India perspectives. Monami, do you want to share? And then Richard, I'd love to hear your thoughts as well.
Sure, I can go first. And based on absolutely on experience that India has had, I think the latter makes more sense. Have adoption first, see if there is a proper demand and supply for it, see if people are willing to kind of see the merit of the public good at the beginning, but also have a threshold for participation, that if it reaches this level of participation, this amount of data pulls, what is the kind of cost it might be incurring? And the cost could be across compliance cost, API infra, consent logs, cybersecurity, audit, legal. All of these are very costly for any fintech, any bank, right? So once you hit that threshold of participation, you should definitely look into designing a fee or designing a commercial model, but also have that on an iterative basis. Every year that should be renewed, should be readjusted to what's happening in that year. Is there absolute good demand and supply for that model in the economy, and is it at large benefiting as well as lowering the cost that it has promised to replace? Ultimately, in India, the story is that any DPI or any open finance solution is supposed to create more efficiency. It's supposed to reduce the time from, say, 4 days to 40 minutes. And if that's happening, there is merit, but there is a cost involved. So that has to be thought through.
Excellent. Richard, final word before we conclude?
Yeah, I very much agree with that. I mean, it just would not have been possible in the UK, trying to establish, the difficulty is trying to establish a commercial model where there is high cost of investment required at the outset, and very low initial transaction volume means that there's you have to take a very long-term view on payback in a commercial model of that nature, and that becomes very difficult for the commercial negotiation, and you can result, I think, in pricing that's not attractive. So it's good, I think, to have seen that sustainable growth of volume, so that people understand. And actually, some of the prize of this in the UK is that the regulatory free APIs will convert to the commercial ones in due course. So you've got a better business case if you do it in that order, I would say.
Yeah, so a gradual implementation. And I think in the first few years, making it work and making people participate in good faith is probably the key aspect. And then you can get to the sustainable commercial model. I'll just conclude by saying it'll be interesting to see. The UAE has just launched, and they have cost recovery from the outset. So it'll be interesting to see how a model like that, and they've talked about how they've sort of built on the experiences of UO pioneer markets. It'll be interesting to see how that plays out with commercial cost recovery embedded from the beginning. Well, thank you all so much. I think this is the most fascinating and opinion generating topic in open finance. And it's really, it's one of the next big ones we need to tackle. And it's great to hear from all three of you in markets where you are now reflecting after a few years and thinking about the future of pricing and these questions of public good versus commercial sustainability. So I look forward to discussing this further, and those in the chat. If you want to dive into this deeper, just send me a note. Several of you, I think, have my email or LinkedIn, and I'll be happy to follow up. And maybe we could even ask some questions of these wonderful panelists if they don't mind indulging us. Wonderful. Well, thank you all so very much, and have an excellent rest of the day and the rest of Financial Inclusion Week.